the micro aspect.
The real estate business, we have offices.
But my name's Andy. I'm here with my colleague Rory. Obviously, the Japanese economy is a very large economy, the world's third largest. Japan enjoys a stable political environment and a very strong established legal framework. There are few restrictions on foreign ownership in Japan, making it easy for institutional investors I work with to acquire assets here.
So here, looking at the investment volumes by investor type, what we really wanted to do here was highlight the percentage of cross-border investment, which is that line graph going through. And you'll notice that since 2019, it's varied between about 25 and 30% of the total investment share into Japanese real estate, which we consider to be quite a significant amount.
Over that kind of 10-year horizon shown in the chart, J-REIT occupancy rates are consistently in that kind of 94 to 98% range. But again, with the normalization of working habits, with a normalization of the environment in Japan, you can see that that black line representing the multifamily sector has seen an uptick in rents coming into 2022. So funding costs here are attractive. There's a healthy spread between that funding cost and the yield you'll get from investments here. And with the leverage which is available, some very attractive cash-on-cash returns are available to investors.
These sorts of players are big institutional investors, pension funds, insurance funds, sovereign wealth funds, and also REITs. And it really highlights the institutional nature of the multifamily sector.
This is basically over the last 15 years. And what that shows you is that from a risk-adjusted return basis, it's better than office and retail. And also from a volatility basis, again, it's better than office and retail. So on the left-hand side, it shows the income over the last 13 years in the four cities that we're looking at. So Greater Tokyo, Fukuoka, Nagoya, and Osaka. So we can basically see that pretty steady. And we also wanted to cover, I guess, two black swan events, which was important to us. Number one, the global financial crisis. Number two, obviously, COVID. And I think if we looked at the worst case scenario from an economic standpoint, which is the GFC, we can see that rents dropped by 10% in multifamily versus 40% in office. And again, there's the sort of uniqueness of investing into Japan. It is very common for tenants to stay in place for a long period of time. Again, if you look further into this, into employment, they just don't tend to change job that often. We don't anticipate in the near to medium term that we're going to see interest rate rises. And at the same time, we don't anticipate, again, looking at the Bank of Japan's sort of dovish stance towards monetary policy, that in the near to medium term, we'll see any changes in monetary policy either. And in terms of the sector last year, which is the third column down, multifamily transactions were totaled at $6.4 billion last year. So there is a thirst for multifamily in Japan. But perhaps most importantly, in terms of creating rentability, a common problem, it's not unique to Japan, but unaffordability in real estate. Low wage growth, property pricing going up is obviously creating that unaffordability, which is very much creating that sort of rental pool for us. The cap rate compression in the market is taking place. We have seen it in Tokyo, of course, already. There's no surprises why we're not buying in Tokyo, because it's compressed quite significantly. It's just expensive. So trying to find that arbitrage between cap rates is actually very difficult to do. So no surprise, we're looking at other major cities in Japan. So we have much more demand coming into the market. We've seen it sort of domestically and internationally from institutions looking to buy, but the supply is not keeping pace for a variety of reasons. One we pulled out there, but there's a 20% reduction to 2030 due to COVID-related delays. And of course, if we throw into the mix as well, obviously the cost of raw materials going up, this is going to have an effect on development at the same time. So less supply in the market, more demand is creating that competition for pricing. But to be very open, what we have to look at is the context here in terms of where it sits on the risk scale. This is clearly very low on the risk scale. Where this suits clients is those clients looking for three things. They are looking for a steady, very predictable income, which is hard to find. They're looking for some growth on top of that. And they're also probably looking for some degree of capital protection at the same time.
The short answer is probably not. Repurposing existing multifamily into something more suitable to the hybrid working environment is going to be quite challenging. What I am hearing, though, is that for new development, it's something which developers and investors are looking into. A slightly different kind of product which will provide facilities, amenities, and the space to allow a degree of home working. But I think for the modern multifamily existing product, the type of asset which QIP are looking at, it's probably quite difficult to repurpose those buildings.
Just to pick up one point on your population, and there's a bit of a dichotomy, but we all know that Japan is, of course, an aging population, a population that's decreasing by those sorts of numbers, and there's talk of the population being below 100 million by 2050. But what's important, and what we like about this asset class, and what drives us to some of these locations, is that the urban cities like Osaka, Greater Tokyo, Nagoya, Fukuoka, these cities will look to have net migration positive positions, obviously through urbanizations, through frankly just better jobs that people are flocking to. So a lot of the macro trends, it's worth just calibrating that with the micro aspects of the fact that these cities will have net positive migrations. These cities will have the need for these residential housing at fairly medium long-term, sort of 2+ year period. So, the micro aspects is really what is worth focusing on.